Welcome to the International Accounting Channel. First time joining the program, remember to subscribe to the channel, like, share with everyone. Today we share with you the lesson on current assets. Now, let's get started. What are current assets? A current asset or liquid asset is any resource a company can convert to cash within a year. This includes cash, accounts receivable, and inventory. Maintaining sufficient current assets helps businesses cover short-term expenses, such as payroll or bills, without financial strain. In contrast, non-current assets are resources with a longer lifespan, usually more than a year. They cannot be easily converted into cash within a short time frame. Non-current assets include property, manufacturing equipment, long-term investments, patents and trademarks. There are three main sections on the balance sheet: assets, liabilities, and equity. On a balance sheet, assets are listed in order of how quickly they can be turned into cash, also known as asset liquidity. Current assets, being the quickest to convert into cash, are listed first. So, if a company needs to pay bills or make immediate investments, it's the current assets. They will come. That is why we need to maintain a healthy amount of current assets to keep the business running smoothly. We have 7 types of current assets, such as cash and cash equivalents, marketable securities, accounts receivable, inventory, supplies, prepaid expenses, other liquid assets. Cash and cash equivalents include cash, bank deposits, and assets that can be converted into cash in a short period of time, such as short-term savings bonds, short-term investments, and foreign currency. Marketable securities are investments that can be readily converted into cash and traded on public exchanges. For example, standard marketable securities and short-term investments that are easy to sell. Accounts receivable is the money that clients or customers still owe you for services already rendered or goods already delivered. Inventory includes finished goods, work in process, raw materials, and supplies. However, not all inventory counts as a current asset. Any inventory you think you'll keep for more than a year should be considered a fixed asset and listed as such. Supplies are tricky because they're only considered current assets until they're used, at which point they become an expense. If your company has a stock of unused supplies, list them under current assets on your balance sheet. Prepaid expenses include anything you've paid for but expect to benefit from over time. If you've paid for a year-long lease or an extended insurance policy, you have prepaid expenses. Report these on your company's income statement over the period the payment covers. Other liquid assets are any other current assets that can be easily converted into cash within 1 year, such as IOUs or tax refunds. How to calculate current assets? Current assets equals cash plus cash equivalents plus marketable securities plus accounts receivable plus inventory plus supplies plus prepaid expenses plus other liquid assets. How to use current assets on the balance sheet? Another way current assets can be used on your balance sheet is for calculating liquidity ratios. By showing you the balance of assets to liabilities, liquidity ratios give you a sense of your company's financial health and help you understand whether it can meet its short-term financial obligations. Here are some common types of liquidity ratios. Current ratio. The formula for this, current ratio equals current assets divided by current liabilities. Quick ratio. Here's the formula for this. Quick ratio equals cash plus cash equivalents plus marketable securities plus accounts receivable, divided by short-term debt plus accounts payable plus accrued liabilities and other debts. The quick ratio helps you understand how well your company can meet its financial obligations in an even shorter term. Instead of looking at total current assets, a quick ratio only considers assets that can be converted to cash within 90 days. Net working capital. The formula for this, net working capital equals current assets subtract current liabilities. Calculating net working capital gives you a clear view of your company's liquidity, short-term financial health, and efficiency by showing you how much money you could have right now. It's a meaningful calculation and an easy one. How do investors use current assets? The total current assets figure is of prime importance regarding the daily operations of a business. Management must have the necessary cash as payments toward bills and loans come due. The dollar value represented by the total current assets figure reflects the company's cash and liquidity position. It allows management to reallocate and liquidate assets if necessary to continue business operations. Creditors and investors keep a close eye on the current assets account to assess whether a business is capable of paying its obligations. Many use a variety of liquidity ratios representing a class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising additional funds. Thank you for watching our channel. See you again in the next video.